Good morning and good afternoon, and welcome this afternoon to Advanced Options Strategies. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm filling in for my good friend Brent Moores today. Hey, it is Valentine's Day, and that means flowers, and flowers attract butterflies. And so we're going to talk a little butterfly strategy today. I'm joined out there in the chat by my good friend Cameron May. Cameron's a 20-plus year veteran of the financial markets. And Cameron just got finished teaching a great webcast on advanced charting techniques using Heiken Ashi candles. I had the opportunity to sit in on a chat with him. He's going to return the favor right now. He's going to be there to help answer your questions during this discussion as we talk a little bit about advanced option strategies. And thanks for being here with us on this Valentine's Day. If you're here with us live, or if you are here with us in the recorded version, thank you in both circumstances. Let's talk a little bit about some of our housekeeping items. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any strategy or security or particular pattern or idea. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies, including butterflies, will involve multiple commissions and transaction costs. Remember that spread trading, including butterflies, must be done in a margin account. Make sure that you're aware of those specifics of a particular strategy before you consider it. We're going to be using technical analysis and probability analysis today. Both of those are theoretical in nature. None of those are guarantees as to what's going to happen in the market. Remember that Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It is not a guarantee of future success, but it's a great sandbox to learn in and practice. Make sure that you're aware of the fact that anytime you are short an American style option, there is the potential that option could be assigned early. And it becomes a particular consideration when we start talking about butterfly spreads. So we'll talk about some of those considerations. But remember, Paper Money platform does not facilitate the early assignment of short options. So as you move your practice from paper to live trading, be aware of those characteristics and those risks that are entailed by trading in a live platform, including the loss of principal. When we talk about rolling strategy, remember those are not magic wands. They don't reduce transaction costs, and they require a liquid market in the target option and strike price. Also, remember, the past performance of any security or strategy doesn't guarantee future results or success. And if we do talk about stop orders, remember the stop orders are not a guarantee of the execution price of the order. We can specify the activation price, but not the execution price. So with those things in mind, let's jump into our agenda here really quickly. We're going to talk about current market conditions. We're going to discuss the construction of a sample advanced option strategy, in this case, namely a butterfly spread. We're going to look at some examples here on the Thinkorswim platform. And as we do that, again, you've got Cameron May out there as a resource to ask questions. Also, another resource, you can follow me. You can follow Cameron on X, formerly known as Twitter. I'm at Ben Watson CS. Cameron is at Cameron May CS. So great, easy way to follow us and stay connected. And then as we switch here to the Thinkorswim desktop software platform, good reminder, if you notice down here on the bottom right corner, click on that subscribe button. That's going to click and allow you to sign up for that subscription to the Trader Talks webcast channel, where you can set up alerts for new content. You can be reminded of archives that are posted, stay connected to the Trader Talks webcast community, and it is at no cost to you. So it's a great subscription. So we'd love to have you do that with us today. Now, taking a look at the market, for the course of this last week, we've been seeing really kind of some neutral movement. In fact, for the last, month, we've been seeing a relative amount of neutral movement, kind of in this little bit of a squeeze area. We saw a little bit of a move yesterday up above this resistance level, and I'll kind of squish this back down a little bit so you can see it. But you can kind of see where that top was above that resistance, the resistance here at about the 60.95 mark on the SPX, maybe sitting right back down on that. The SPX sitting right now at 61.21, so a little bit above that previous resistance level. RSI relatively flat. Nevertheless, if we kind of zoom back out on this, we kind of see where we are. It's still relatively neutral movement over the course of the last month or so. And that translates into kind of a different characteristic, right? Because if we look at the NASDAQ, we see the NASDAQ a little bit stronger than the broader S&P 500. And that would suggest that maybe there's a little bit of leadership coming back into some of those technology names, meaning some big moves. We've seen some big earnings plays. We've seen some big up moves and down moves in some of the technology leaders. And if we look at the Russell 2000, we see that the Russell 2000 may be a little bit weaker than the other two indices. And so maybe some of the laggards overall in the market coming in the form of some of those small cap stocks. So some downside potential movement. But in all three of these cases, well, maybe at least two out of these things, right? So we'll say one of these things is not like the other. Two of them are relatively similar to one another. And they're all relatively neutral. I mean, we're not in a big trending mode necessarily yet amongst these broad market indices. We'll talk a little bit more about that later this afternoon when I teach the Market Movers webcast later today, where we talk about what's gone on over the course of the last week and what is to come in the week to come. We'll see how that works. But as we look at this here right now, one of the other things I want to pay attention to before we get into any particular individual strategy is what's going on with volatility, right? And we see that volatility still starting to bleed off. It's still relatively high. I mean, relative to where it was in December, relative to where it was last summer, it is still relatively high. And it's not spiked significantly, but it's still kind of staying up in that 14, 15 range. Now that's okay. You got to put that. That's why I keep saying it's relatively high, right? Because you have to put that into context. It has been higher. It has stayed higher, but at the moment it's not terribly higher. Individually, some stocks have some pretty elevated volatilities, however. So, because of that, right? Because of that idea, because individual stocks may have elevated implied volatility, now we have to kind of look at a more granular level. And TMS, great question, right? So with so much uncertainty out there in the market, why volatility is barely moving? And I think that's a great question, but I'll tell you what. If we go back over here to kind of this comparison of VIX to SPX. So the purple line here is the SPX. We see the SPX has been, and is likely to, but that's not a guarantee, moving in a bullish uptrend. And because that market is moving in a bullish uptrend, institutions typically tend to be slow to buy protection. When the market is in a bullish uptrend, institutions typically tend to wait until discrete events occur, as opposed to buying protection and holding that protection for a long period of time. So we start to look at this comparison here, which is the VVIX, the volatility of VIX compared to the VIX. And we've looked at this before, but the volatility of the VIX, the VVIX, is kind of a measure of how much variance there is in volatility. And that seems to be ticking back up a little bit. It can also be a measure of kind of the relative expensiveness, if you will, the relative cost of buying protection. Cost to buy protection still relatively high relative to the movement of volatility. So this would put us into a situation where it becomes perhaps a little bit more prohibitive to buy protection ahead of time, and maybe a little bit more so beneficial to buy protection once things have happened and then take that protection off. So that's one of the reasons maybe why volatility really hasn't ticked higher. But on an individual basis, on an individual stock basis, that's when you start to see some higher volatility levels. So let's do that. Let's kind of switch over to our single grid here, and let's kind of put this into the context of why we might use a butterfly spread. So I'm going to pick a particular stock that we might use in this particular circumstance to illustrate a butterfly spread. And so it's one that has an earnings announcement coming up. And if we take a look at Oracle, for instance, Oracle has an earnings announcement coming up here on the 10th of March. And you notice from a pattern perspective, Oracle's kind of making this symmetrical triangle, right? It's kind of squeezing down into this relatively narrow range, maybe kind of centered right around here, this 172 mark or so. Currently trading about 173.5 or so, and so kind of centered itself right around that 173, 174. If we come up here to the Flask icon on the chart and we type in IMP, implied volatility, and we put implied volatility on here, one of the things that we've noticed is that implied volatility, if we take a look at this implied volatility, it is pretty significantly high. In fact, it's up near the top of its particular range. Only one other time over the course of this last year has this implied volatility been higher. Now, the lowest that it's been has been down here in about the 18% range. Right now, it's sitting at about the 49 to 50% range, which would suggest if we were just to look at that 50% number, we wouldn't know if that was high or low. That kind of falls right in the middle, doesn't it? But looking at it here in context, we can see that the current implied volatility of this stock is, like I said, almost as high as it's ever been. So options are trading at a high, generally an elevated cost. And there's not a lot of expected price movement here. The market's kind of come to a consensus. We've got an earnings announcement over the horizon a little bit. And you can see that this is a typical pattern that this stock tends to make, is that implied volatility tends to peak ahead of an earnings announcement, and then it kind of bleeds off prior to, or at least it abates somewhat. That rise abates somewhat. So we might be seeing this implied volatility kind of staying about where it is. So how do we take advantage of neutral stock price movement with high implied volatility? And we might say, well, okay, that becomes a seller's market, right? We sell options. But if we sell options, we've either got to spread them out directionally, and then we're taking a directional assessment, or we have to buy high implied volatility. And that becomes a challenge too, because buying high implied volatility and implied volatility getting sucked out, that eats away at that option premium that we bought. So what if we combined the two, but we combined it in a way that was a higher probability, well, lower probability of success, but benefits from higher implied volatility? So what if we were to put together a trade where our expectation was that the price of the stock was going to stay in a fairly neutral range within a certain amount of time, and it benefits from selling that higher implied volatility, and implied volatility generally staying about that area during the time frame of this trade? So we could do something like a four-legged iron condor, selling above and selling below and creating a directional expectation. Or we could do the condor's kind of distant cousin, which is a butterfly spread. And in this particular case, we're going to put on a long butterfly spread. So an iron condor, typically we tend to send an iron condor out as a credit spread, right? We're bringing in a credit. The butterfly spread typically is created, but it can be created otherwise, but it's typically created as a long butterfly spread as opposed to a short butterfly spread. So let's see how we would go about creating this trade. And our expectation again is high implied volatility, relatively neutral or stable, and stock price movement relatively neutral or stable. And as TM says, a butterfly spread maybe has better risk to reward potential. So let's see what we can look at here. So let's go to the trade tab for Oracle here in this particular case. So what I'm going to do is I'm going to come down here and I'm going to look at the option chain, and I'm going to say, look, where is there some elevated implied volatility? The 0 days till expiration option has some elevated implied volatility, but we're a little bit late in the day to get into a 0 DTE spread. And we could certainly do a 0 DTE butterfly spread, and that is a strategy that we've talked about before. But it's a little bit like those oftentimes some traders will put those on early in the morning after the market has kind of settled a little bit, and then take those trades off, look to take those trades off close to the end of the day, but not holding them into the end of the day. But here we are, most of the day has already passed. We're kind of long in the tooth for that butterfly spread. So we're going to look out and see where maybe there was a little bit more elevated implied volatility and still stays within the kind of the context of, or the confines of, our earnings announcement coming up on the 10th of March. And by the way, speaking of long in the tooth, we've got a feedback survey down there in the chat. Cameron will pin that up to the top. And do me a favor, if you wouldn't mind. That's how we make these sessions better for you. Click on that link, set that webpage aside as it opens up, and then you can come back to it and finish it at your leisure. If you don't click on it now and then set it aside, if you just wait, there's the risk that you run of maybe not being able to fill that out. So I'm going to go out to the expiration here. That is the 17 March. Actually, I may even go out to the 14 March, knowing that I'm likely to close this trade down prior to expiration. I'm not going to hold it all the way till expiration. So the 14 March expiration, 28 days to go until expiration. If you notice, its implied volatility range here is about 47%, right? 47% implied volatility. That's relatively elevated over the 7 March. Now, I could choose the 7 March if I were looking at, I just wanted to avoid the earnings announcement completely, but I'm looking to get out of this trade prior to its expiration. So I'm going to get into the trade here theoretically, and out of the trade theoretically ahead of this earnings announcement on the 10th of March. So that's going to take us to the 14 March expiration. So we benefit from a little bit higher implied volatility. So I'm going to click on open. I'm going to change the number of strikes here down to like 20 strikes. I don't need to display 100 strikes in this particular case. And in order to create this trade, because it has higher implied volatility, well, let me throw this question out to you. Which side of the option chain, calls or puts, generally reacts, from a premium standpoint, generally reacts a little more strongly to rising or high implied volatility? Is it the call side or is it the put side? Do calls increase more, or do puts increase more when implied volatility, right, is high? So Duke asks a great question while you're thinking about that. Is implied volatility expected to continue to increase as earnings approaches? Potentially, but that's not kind of what the chart was telling us, right? If we go back to the chart and we see that implied volatility tends to kind of go sideways ahead of the earnings announcement. So it's not likely to rise and it's not likely to fall. And you guys are answering the question. You're saying puts, and you're absolutely right. So we're going to create this butterfly spread with put options. And so what I'm going to do is I'm going to look at my current trading price of the stock as I put this trade together. I'm going to find my at the money strike. So currently trading at 173.48. So that means I'm a little bit closer to the 175 strike. Okay, so my 175 strike, excuse me, right now is my at the money strike. So here's how I'm going to create this trade, right? Yes, Kevin, you're absolutely right. Bollinger Band squeezes into earnings. That could help this strategy as well, especially if we're getting out of the trade prior. So look at what we're going to do. We're going to do this. I'm going to hold my control key down, and I'm going to sell one of the 175 put. I'm going to come back. I'm still holding my control key down. I'm going to sell another one of the 175 put. Now, if I were just leave it right here, right, I'm benefiting from a lot of implied volatility. These are relatively expensive options. Greatest amount of extrinsic value in the at the money strike. I click on confirm and send. And now I've got to say, oh, wow, I'm selling this put. I got to hold a lot of cash in my account to trade this as a cash secured put. If I were to just leave it at this point, right? Maximum theoretical loss is being put the stock and it going to zero, right? Well, we're not going to leave it there because that would be a low probability, high cost or high potential cost trade. So what we're going to do is I'm going to drop my order box down here and we're going to balance this out. We're going to create some wings on this butterfly. So think about the short legs, in this case, the short puts, as the body of the butterfly, And what we're going to do is I'm going to go just for easy math because we have $5 wide increments here in the strike prices, is I'm going to hold my control key down and I'm going to buy the 170 strike. So I sold 2 of the 175s. I'm going to buy 1 of the 170 strike, and I'm going to buy 1 of the 180 strike. Oh, wait a second. Now I still have those 2 short legs, but I bought 2 legs against that. I've sold a lot of extrinsic value, and I bought a little bit of extrinsic value to the tune of a 53-cent net debit, meaning this trade went from costing me or potentially costing me $33,000 if the stock were to go to zero to now my maximum risk in the trade is $50. I click on confirm and send, and I can see my maximum risk. I can see also my maximum profit in this potential trade. So this is one of those things that we kind of have to think through mechanically, right? Let's think through the scenarios here. So let's edit this and let's kind of analyze this trade really quickly. I'm going to right click and I'm going to send this to the Analyze tab. So here's the Analyze tab. And if you remember, this is profit and loss compared to stock price. Profit and loss on the x-axis, or on the y-axis, stock price on the x-axis. Okay, so 175 is my center strike. I'm going to grab my magic marker here and I'm going to say, all right, let's draw a target here. Maximum theoretical gain on this trade is achieved if at expiration, which we have one discrete expiration, it's not a calendar spread, 14 March, right? 14 March, that expiration, if this stock expires right at that 175 strike, okay? So Isaiah, here's what situations. Neutral movement, high implied volatility. That's a condition that is conducive potentially to a butterfly spread. But we got to get really lucky in order for that scenario to happen, right? And if we don't get really lucky and the price of the stock doesn't hit that discrete target, that 175 strike at expiration, we could end up in a couple of different situations, right? So the other situation, so that's scenario 1, right? Scenario 1, we get lucky and it lands right on our strike. Scenario 2, the price of the stock is, in this case, below 170, right? Or below, or above, above 180, right? It makes a big move outside of that range, that range that we've just decided, right? That's where we see our loss. But what was our loss? 50 cents times 100 shares, $50 in the trade. So if this makes a move, I mean, from a risk to reward potential here, that's a small cost to enter this trade. Now, could you take that loss? Yeah. Is there the possibility that the stock can move above 180 and below, or below 170? Yeah, that could potentially happen. But what that leaves us with is, look at this range right here. That whole area that the price of the stock could be within between now and expiration. We're not going to hold it all the way to expiration, but between now and expiration, the price of the stock could be in a lot of different places there, and we could get some potential gain in the trade. So oftentimes this is a trade that we will look to take off somewhere between 25 and 50% of maximum theoretical gain. Not looking to achieve maximum theoretical gain in the trade, right? We're looking to capture something in this trade, as opposed to maybe trying to get lucky in this trade. So here's how we're going to do this. Let me just kind of bring my scratch pad over here from the side. So I wanted to talk about this, maximum gain. So the question is, well, how do we calculate maximum gain? So there's an easy way and there's a hard way. Easy way is we put our cursor in our Analyze tab up here at the top, and we say, all right, it's right about 430, 440 is our theoretical maximum gain in the trade. We put our price on the 175 right up there, and we can see where that is, about 445. Okay, that's the easy way. The mathematical way, because I know some of you are mathematically inclined, And you might say, okay, fine. How do we calculate this mathematically? So we take our max gain, and from that max gain, here's how we calculate it. The middle strike premium, what we sold those middle strikes for, minus the net premium that we paid. So in this case, let's go back to our trade tab. What was our middle strike premium? The 175 premium. So let's call it $9.20. $9.20 minus what was our calculated net cost of the trade, the net premium that we paid in the trade? About 50 cents, about $8.70. So this is mathematically correct. The Analyze tab also takes into account probabilities. So we're going to go with what the Analyze tab says, which is our maximum theoretical gain is about 440. So let's do this, $4.40. And by the way, also this maximum gain right here assumes that it expires exactly at that strike and we don't get called, so we avoid any pin risk, right? The possibility that we get assigned at expiration when our long legs have expired. So, this is maybe one way to think about it. I think using the Analyze tab is another way to think about it, and probably the more realistic way to think about it in terms of kind of detuning our expectations somewhat. So I'm going to take $4.40 and I'm just going to divide it in half. Divide that by 2, that's $2.20. So to that $2.20, I'm going to add what it cost me for the trade, 50 cents. So if I can get out of this trade, if I can sell it for $2.70 or more, I've captured 50% of my theoretical maximum gain in the trade. Now it becomes not necessarily a lower probability trade, but becomes a higher probability trade, right? Because all we've got to achieve is that $2.70 mark price on my butterfly that I'm paying 50 cents for. Cool. Okay. So let's do this. Let's go back to our order and let's bring our order up from the bottom. And let's say, all right, fine. Now what we're going to do is we're going to create this as a first trigger sequential, and I'm going to right click and I'm going to create an opposite order, which is the order to sell this butterfly spread, right? I'm going to sell this butterfly spread if at a limit price, if it gets to $2.70 or better, and I'm going to make that a good till canceled. So I'm going to get into the trade for about 50 cents. I'm going to get out of it theoretically and hopefully at $2.70. And if it goes against me, my maximum theoretical loss in the trade is 50 cents. Okay, let's calculate our return on risk here. So that's about 50% return on risk, right? So let's just kind of calculate that. Well, actually, it's even a little bit more than that. $2.70 divided by, so what we made divided by what we paid, right? So 50 cents. There you go. So in this particular case, wow. So this kind of is a low cost, lower probability, but capturing neutral movement and taking advantage of high implied volatility type of trade. So we'll go ahead and we'll send this order off. Click on confirm and send, make sure that we're aware of that. And again, I don't know about you, but a buying power impact of $50 versus a buying power impact of $33,000 is perhaps a little bit more efficient use of capital in our portfolio. So I'm going to put this in our long verticals and diagonals group here. We'll click on send and we'll fire that order off and we'll see if it fills. And we might have to work it a little bit to see if to get it to fill. There it is in our working orders. Let's right click, cancel, replace. Whoops, that was the wrong one. Let's do this. Let's delete that. And we're going to come back to our monitor tab. And here's our order to buy. Right click, cancel, replace. We'll open up that lock a little bit. We're getting it for, wow, we can pay as much as 68 cents here. Our risk to reward goes down just a little bit, but I'm okay with that. And once again, we're going to put it back in our long verticals and diagonals. We're just going to work this order a little bit. And we bought it for 60 cents. We paid about 10 cents more than we were looking at, right? So let's see where that would be, about 270. So 270, right, which is where we wanted to sell it, kind of occurs right here, and 270 maybe right there. So in between about 178 and 171. So about 178 to 171, that's the range, Mighty Mouse, that we might expect that price would be. And if we were going to just kind of draw that in here, what we're doing is we're capturing kind of this fat middle section of that probable range. So butterfly, again, can be a precise tool to get to maximum theoretical gain, an imprecise tool in this type of circumstance where we're looking at taking that trade off at a lower probability but a lower gain potential, right? So that's how we might approach a long butterfly. And to answer the question that TM asked, why are we using puts again? Because the puts have benefited from that rise in implied volatility more so than the calls have. So let's take a look at another one here. Let's go out to our charts and let's take a look at CRM. This is Salesforce. We see elevated implied volatility. It typically tends to do the same thing. This is a little bit shorter dated. We've got the the earnings announcement on the 26th, and movement is relatively neutral. It's kind of squeezed down in this relatively neutral range, right around that 326 mark. So let's go to the trade tab for CRM. And once again, our elevated implied volatility is going to come in this earnings or in this expiration cycle right here, the expiration cycle that expires on the 28th of February, 14 days to go until expiration. We're okay trading in that range because we know we're likely not going to be in this trade prior or after the expiration, or excuse me, after the earnings announcement. And we're going to do the same thing. So stock's currently trading at 326.74. So that's almost 327. So we've got a 327, or we've got a 325. We've got a 327 half put. We've got a 330 put. So our at the money strike is our 327 half. So let's just do the same thing, right? So Isaiah, let's do the same thing. Let's widen this out a little bit. So let's try that and see if that works. So I'm going to do control, and I'm going to sell 2 of the 327 halves, 1 and 2, right? There's our short legs. That's the body of the butterfly spread. And we'll go out to the 317 half and buy 1. And we'll go out to the 332 half and buy 1. Now, this is an equidistant butterfly. In another class, we'll talk about using broken wing butterflies, which is where we skew it a little bit, right? Okay. So we've widened this out a little bit. We've got not just gone one strike wide, we've gone a little bit wider in our strikes. So let's do this. Right click, analyze the trade. And this ends up being a little bit of a broken wing simply because of the positioning of those strike prices, right? Oh, you know what? Never mind. Never mind. Interesting. We actually end up selling this. It ends up being a little bit of a credit because of the positioning of those strikes. So what we're going to do is, this is where we kind of get to come back and play this bespoke game, right? We can custom tailor this trade to what we want it to be. So I'm going to kind of widen out one of these sides, right? So let's take a look here. Maybe we've got to go out to the 337. That's what we've got to do, is go out to the 337 instead of the 332 half to keep these equidistant to one another. So let's bring that up, and let's go out to the instead of the 332, let's go to the 337. And now let's go to our Analyze tab, and let's take off that one. There we go. That looks a little bit nicer and a little bit cleaner, but you can skew them that way and make them broken wing, right? So Lawrence, this is a lower potential loss than an iron condor possibly, and it benefits from implied volatility kind of staying exactly the same. Benefit, if implied volatility does fall, it doesn't hurt it too much, but a lower cost to entry potentially, or lower potential maximum loss than an iron condor spread when it comes to that risk to reward. So $1.25 debit. And again, let's put our cursor up here. We can see that our maximum theoretical gain is 870. So let's come over here to our calculator, $8.70 divided by 2. Let's divide that in half, $4.35 plus the $1.25 that we have to pay for it gets us to 50% of our maximum theoretical gain, which would be around $5.60. So where do we see $5.60 of maximum theoretical gain? Up here a little bit, right? So we kind of follow that cursor right about there. And so 324, and then also right about there. So 330. So narrower range, but we've widened out that range in which we get some potential gain, right? The base of this butterfly is a little bit wider, right? So what I did, Christopher, is I went to the trade, I right-clicked and clicked Analyze Trade, and I sent it to the Analyze tab. That's where we are now, right? We send it to the Analyze tab, okay? So now what I'm going to do, first trigger sequential, we'll make that a first trigger sequential order, okay? And we're going to now make this a opposite order, and we're going to say, fine, sell it back. We bought it for $1.25, sell it back if we can sell it back for $5.60, right? And we'll make that good till canceled. And we'll click on confirm and send. We'll read through this order. Buying power impact here is $1.30 times 100 shares, $130. Now, can you lose money on this trade? Absolutely, because the price of the stock could move, right? And you got to be aware of that. But at the same time, it's a lower cost entry. So now some of you are saying, well, wait a second, why don't I put a stop on there and lose less than that $1.30? I mean, that's the thing. Typical volatility of options, especially 4 legs of an option, means that there's a pretty good chance you may get stopped out quickly in that circumstance. So we want to give this trade every chance to make it, right? And so in this particular case, we don't typically tend to manage this from that standpoint, managing a loss. We typically tend to put, traders typically tend to put, and again, not always, but typically tend to put simply a closing order on to take it off if it's achieved its maximum gain. And they do it as a whole, typically not taking this trade off at a particular level or when one side or the other. Because realistically, if you think about it, if one side's getting threatened, the other side's still pretty close to being threatened as well, right? If that price is pretty close, because we've got the same strikes. From an iron condor perspective, right? You think about what an iron condor is. An iron condor is the same thing, essentially, or actually a condor, not an iron condor, because an iron condor uses a call vertical and a put vertical. Just a straight up condor, which uses all puts or all calls, would widen out the difference between the body strikes, right? And give us a scenario where there was a higher range of maximum theoretical gain, but it's going to cost us more. So again, that's kind of the scenario here. So the price to get the projected gain is 50% of the maximum gain plus the cost of the premium that you paid to begin with, right? Because you got to overcome that to get 50%. So yeah, this is not necessarily a bearish play, but this is a neutral play, right? Right? So the price can stay in a neutral range, right? That's what we're expecting, is this price to stay kind of within that range. So the other thing that we might think about here too is what is the stock likely to do in terms of its movement? So let's go back to the trade tab and let's look at this expiration. And we've got about a 30-point range based on current implied volatility, up or down from where the price of the stock is right now. So 326, up or down 29 points. So let's just do that. 326 plus 29 is 355, and minus 58, which would put us on the downside, 297. So you can kind of see where that is. 297 down here. That's the expected range based on current implied volatility, right? And 355. So we're expecting the price of the stock to stay inside that range. And in fact, we're expecting the stock to stay fairly close to this range, right? Based on that implied volatility. So that's the thing. We're gonna look at taking this trade off if it gets to that point. If we get close to expiration, and we're realizing some of that potential gain. Again, this is one of those things where we may not take this trade all the way till expiration. But if we do, we got to think about what the scenario is, right? The price of the stock closes below or above those short strikes, or above or below our legs. Well, then all those options would expire worthless, and we would lose potentially our cost to enter, or our premium that we paid for the trade, right? Because here's our we're at 327.50, right in the middle. And if the price of the stock is above our short leg up here, or excuse me, above our long leg up here, all of those strikes are going to expire worthless. If the price of the stock is down here, below all of those strikes are going to expire worthless, right? So that's kind of the scenario here. If it makes a big move, great. We took our maximum loss. So don't be afraid of taking a maximum loss in this type of scenario. We're not going to manage that maximum loss, but we're going to look at taking this trade-off when it gets us some potential gain in the trade. In this case, we've been structuring these at 50%, right? So, is this a strategy that you would use all the time? No, not necessarily. Is it a strategy that you might use for neutral price movement? Yeah. Neutral price movement and high implied volatility? Yeah. Because that high implied volatility means, very simply, that the at-the-money strike, either the call side or the put side, that at-the-money strike is trading with inflated extrinsic value. And we're taking advantage of that inflated extrinsic value because we are selling that inflated extrinsic value and expecting that it's going to go away. Speaking of that, don't go away before you fill out that feedback survey, which is down there in the chat right now, and take an opportunity to fill that out. Let me give you some additional resources if you want to learn more about this. Come right back over here to the Trader Talks webcast page and type in butterfly. Type in the word butterfly, and you're going to see Brent, who talked about a year ago on the basics of butterflies. I've talked about them. Cameron's talked about them. Right there. Hey, there's a great one. And if you're questioning, setting that maximum profit target on the butterfly spread, this is a great webcast to review long butterfly spreads. And you see a bunch of those other webcasts that you can learn from. Now, if this is a strategy that you have employed or you are considering employing, and you consider advanced option strategies, which is maybe one of the reasons why you're in this particular webcast, come and join us in Chicago if you have an opportunity to do so. Friday, March 21st and 22nd, Kevin Hinks and I are going to be in Chicago, in Schaumburg, teaching the Advanced Option Strategies Workshop. You can go to schwab.com/events and get to this calendar, and you can sign up from here. And in fact, butterfly spreads are one of the strategies that we teach in this workshop. Butterflies, long verticals, iron condors, calendars. We're even going to be talking a little bit about futures, diagonal spreads, and others. We'll look forward to seeing you there. We're also going to be doing that in Dallas and Anaheim this year as well. So we look forward to seeing you there. Again, my thanks to Cameron May for helping out today, my great production staff for bringing this webcast to you as well. Have a great day, everybody. We'll see you again very soon, coming up for Market Movers in about an hour. Take care, everybody. Bye-bye.